everyone, and welcome to another episode of the Eitel Insights podcast. My name is Eitel, and I am the founder and lead analyst for Eitel Insights. Today we're going to be going over the Greater Vancouver detached market. The data just came out for the September sales totals, numbers, inventory, and all of that. The bulls really took it and ran for a short period of time, and now they're kind of backtracking because maybe it wasn't as good as first glance. So we'll get into all the nitty-gritty details as we're known for our analytical interpretation here in just a moment. First of all, we hope everybody's going to enjoy their Thanksgiving and enjoy visiting with family and friends. Hope everybody stays safe, of course. One other thing, since it is a time to be grateful and thankful, thank you very much for helping us grow our subscriber count. We did achieve our goal of surpassing 500 with our last podcast, and hopefully with future podcasts we can continue to grow the subscriber count as well. And with your help, I'm sure we can do it. One other thing before we do get into our content, if you do appreciate today's podcast, we ask that you give us a thumbs up and maybe even leave a nice comment if you're so inclined. It gives us motivation to continue doing this for you and produce content. That being said, let's start getting into the charts here. So I'm going to toss this up on your screen so you can follow along here with a little bit. So what did happen actually here in September was the sales price finished at $1,708,000, which is basically back where February was. So February was $1,704,000, and of course COVID-19 occurred, and prices shot lower right down to that middle threshold indicated by the yellow marker, horizontal line there of the current market cycle. Prices did come close to testing that prolonged uptrend indicated there in the black two lines. Now we're going to be getting into that here in a little bit, and really why our overall thesis is still going forward that prices will be going lower longer. One thing that Eitel Insights will never do to our patriots, to our followers, to our clients is offer you churning advice, which is basically buy today and then in 6 months, well, maybe you should sell, and then maybe buy and then maybe sell. I mean, that makes a lot of commissions for a lot of realtors, but it really doesn't put too much money into your pocket. So we stay away from that, and we give you that long-term advice. So since 2017, when we did identify the triple top, and we were published in the Western Investor article, it's unequivocal, we were the first company to call it a trouble upcoming market for Greater Vancouver. And subsequently, prices in 2019 did dip below the middle threshold and actually test that prolonged uptrend. Now, that was originally occurred in February of 2019 when prices were around $1,480,000. That's right where that first initial blue data line clipped below that lower threshold, the higher echelon of the lower threshold identified by the orange lines there, and tested it a few more times going up. Subsequently, the market said, no, we're not ready to break this threshold at this point in time. We're actually going to go higher. And then if we can't sustain that, we will come down and test it again. That's where we really believe the market is here. And there is a lot of lines on that chart. But if you just pay attention to two lines, which would be the bottom black and that overarching orange line, you do see that we have a sideways triangle. When you have a triple top, which did occur originally in 2016, and then again in 2017 and in October, what you would call your triple top, that's a market reversal. That means that the old trends will actually be upcoming challenged and likely broken. So that's where we get our confidence from. Not to mention, again, this isn't the stock market where this move would be over in a month or a 6-month time frame, long gone, done. We need a month to occur for every data point. So yes, it is sluggish, but that is also why our first forecast said 2021. We did identify in 2019 that stress test mitigated folks, and were basically prices had wiped that mitigation factor out. So purchasing could occur, and then subsequently it did. Now what we're seeing is that real lack of supply in the market, and we'll get into that here in a bit. But why is that? Well, that's because prices are unabashedly lower. Nobody actually wants to sell during this market, right? Unless you kind of have a need to sell, you're not winning the lottery in very many cases. And we'll get into a few examples here, but before we do get into that, I do want to go over just one more technical move, and then we'll get into it. So again, when we say that the market will continue to create lower highs and lower lows, that is exactly what's occurring here again. So if you take the May 2017 as the original peak at 1.830, and then you take October right around 1.820, that was your end of the market upper echelon. Since then, prices did, as we say, come back down to, let's call it 1.5 during 2019. So 2019 creates that low, and then the now 2020 is a lower high than the original high. So now we're down to 1.70, but it's $130,000 off of the old peak. It's not peak markets anymore, folks. So as we have said that any property can sell, or a property can sell, but it will be continually at a lower echelon price. That's what's actually occurring here. And to finish the technical move, basically what we're seeing is an A, B, C, D. Now D is a lower low than the B low. So what are we expecting? Yeah, we're expecting prices to come back down to 1.40 during 2021, and that will be your likely buying scenario. So now what's going on in the market that shows some stability or signs that could be misinterpreted as a bullish market upcoming? Well, what we're actually seeing is a narrowing of the gap between the high-end market and then your entry-level market. So the entry-level market is getting bids. There's offers coming in if your property is appropriately priced in some of the outlying areas of Greater Vancouver. A lot of condo owners, families were looking for a detached property, and with COVID and with the school season coming up, it kind of stood to reason that that this would occur, and it clearly has transpired. So there was that pent-up demand that everybody knew was coming and was being released. What I think is there that isn't prevalent in the market is there was a lot of forecasted demand. So if you're a young family and you're thinking about buying in the next couple of years, well, interest rates are low and there was some availability, and you just couldn't do another school session teaching inside of your condo. You needed a house, so you went out to areas where you could afford. So that brought up that bottom or that entry level market, raised that price, and then simultaneously the high end market actually did dip. So we'll give you a few examples of each of this, but what that does is basically makes that market look like it's going a bit higher than it actually is, because you have your bottom entry level prices coming up, while your high property values, which are still much higher than the average sale price, are actually coming down, but still accumulative help the average sale price look a little bit higher than it is. So we'll give you a few examples of the high end of the market. So there was this one property that had been listed at $13.388 million during 2019, right? That's a high end property. Couldn't sell, relisted in 2020 at $12.988 million. It just sold for $9.85. Now, why would he take a bath like that? That's $3.538 million off of his original ask. So, I mean, he got bent over the barrel, but that again, I mean, did that buyer get a good deal? Probably. Did the seller get a good deal? Probably not. But again, that helps the average sale price by showing in a sale of $9.85 million. I'll give you another example of a higher end market, and then I'll give you that middle market just to show you that it is pretty even, that there are people starting to chase the market lower, but ultimately still help the sales price because detached properties are quite in demand right now. And as we've said in previous podcasts, I really believe that there's a change of money here. So as we've said, money flows from weak hands to strong hands. So properties that were very expensive, maybe some of the businesses are in trouble, or a plethora of things that could have occurred, have actually forced the seller to say, just give me a price, whatever I can get, I'll take. And so that's flowing from weak hands to strong hands. So another example here of a property that took a long time to sell. It was actually on the market for 533 days. Originally listed in 2018 at $6.88 million, came down in 2019 to $5.68 million, and eventually just sold at $4.7 million. So that's a loss of $1.7 million over the last 2 years. Is it a peak market? I mean, there's examples of it. No, the charts say that it's off of the peak. Is it better than 2019? Yes. Do we expect 2021 to be worse than 2020? Yes. So again, you got your going lower, right? So your lower highs and your lower lows. We do expect 2021 to create a lower low than 2019. One kind of median market example. So in August 20, and it was a rapid sale. In August of 2020, the property listed for $1.88 million. September, it decreased down to $1.89 million. It just sold for $1.750. So why would he take $130,000 off of his list price in less than 60 days? Unless it wasn't as buoyant of a market as maybe they had spoken about, and the seller says, no, if there's no offers, let's start reducing prices. And that's what you'll eventually see as this inventory continues to pick up. What we did say about this market is because we had no spring market, everything would be shot out to later months, and that you probably wouldn't expect the usual seasonal activity as we have had in the past. So there is no real reason to panic here. We're just kind of seeing that spring market that we did, or spring and summer market that we didn't see during spring and summer, just pushed to later in the month or later in the year. And now we're going to get into the sales here. I'll toss that chart up on your screen so you can follow along. Now, sales did hit, the completed sales did hit 1,325. And now that's the highest over the last few years, undoubtedly. But again, when you come from that artificial low of April, creating that low channel, it stands to reason that maybe you missed out of some sales from April and May, and they would actually come up. Again, what I believe is occurring is that forecasted demand. If you had to purchase, sometime in the future, end of 2020, beginning of 2021, middle of 2021, you didn't really know what the second wave of COVID would look like. And there was some clear signs that there would be a second wave of COVID. So maybe you forecasted your purchasing and you bought now just so that you could actually have that detached property. So your kids could run around in the backyard rather than sitting through the condo and maybe getting a property closer to the downtown core, closer to a Burnaby, closer to a New West. You actually gave up and maybe moved out to a Maple Ridge. That is something that we did say in the Michael Campbell's Insider's Edge article during February that would occur, and we would actually advise clients to stay away from such mentality. So when you have a large mindset descend on a small area, that has a natural effect on prices. So in February, prices of Maple Ridge were only 6% off the top. This last month, they did just create a brand new high by a few $1,000s, but it is above $1 million. What's interesting about that is right now across the 20 markets of Greater Vancouver, there's only 2 markets that are below 1.1 million. In 2019, there was roughly 10 markets that were below 1.1 million. Again, we believe 2021 will be a worse year than 2019, on average. Not all markets are equal, and that's why we offer our independent reports. But there will be in excess of 7 markets that will be below 1.1 million during 2021 and 2022. They will overlap. Some markets are laggers, other markets are leaders. So what's interesting about that is those folks that went out and purchased, you might have given up on your ideal area or market that you wanted to live in for the security of being able to purchase today. We believe that was short-sighted. We advise clients to maybe not necessarily do that, as we had forecasted Maple Ridge to lag the overall market and not bottom until 2022. And this natural phenomena that did occur where people looked for detached properties where they could afford, and you couldn't afford it currently in a Burnaby or in a Coquitlam or in a New West, but maybe you can in the future, and they might be kicking themselves over the next upcoming years and saying, darn, we could have had something closer to our familiar home rather than moving out and starting a new life out there. So of course, time will tell, but over the course of our history, time has continually proven us correct. We don't believe that this time will be any different. We believe there was that real rush to own some land before the school began. Again, 1,325 completions meant that those were sales from previous month that just completed in time for school. School catchments this year being probably more important than many years in the past and probably upcoming years of which school would my kid go to. Stands to reason that this year saw a spike, and then after this we'll start to see some fall off. What will be an interesting outcome of this as I go into the inventory chart is now that the media says sales have occurred and sales spiked 44 or 54% from the year before, which is again is a misleading data point. September 19 wasn't a good month for sales, but they're touting like as if it was, and that this month was even better. No, again on the chart you see that we are out of that identified channel that we had been in the past couple of years. I believe we're going back to that as that need to sell continues to outpace any need to buy. That need to buy was a brand new innovation thanks to COVID. Other than that, there's no investment going on or any of that. So we do anticipate prices going lower as the sales begin to fall back into or decline back into that identified sales channel. So here we go with the inventory. Now, what's interesting about the inventory, I'm going to show you 2 charts, and usually we don't do the detached new listings, but we do with the condo. So we're going to start incorporating this into the detached chart as well, or monthly updates. And I'm going to put the new listing charts up first, so you can have a look at this with me. Now, what's interesting, you do see the 2 downtrend lines. You got an orange line, which is your conservative line, and your yellow line, which is fairly rapid, but again coherent. That yellow line was just broken with the September new monthly listings. There was over 2,000 new monthly listings in September, the highest number. The highest number of the year, but definitely not anything that is peaking compared to years previous. So what I find interesting, again, we showed you the peak month of every yearly market cycle when the highest new monthly inventory showed up. The only time that it was any other time beyond May was 2019. 2019 saw the high again in September, the same as 2020. One major difference from 2019 or 2009 to 2020, 2021 does not have any Olympics coming to Vancouver. 2010 ultimately did, as we know. You can't stop construction. You can't stop the economy when the Olympics are coming to town. So we benefited greatly from that. What's our fundamental reality this time around? We're getting a few government handouts. That's nice. But if you actually had a proper job and you lost it, the government handouts aren't nearly enough to cover your bills. And that's probably why we see a ton of increased inventory into the condo market, but that's a conversation for another day. But it's been great for shoe sales. If you didn't have a job and the government gave you free money, Nike's doing very, very well, but actually Foot Locker isn't. So the Foot Locker owner, can't keep as many employees because people are just straight buying online. So it's a different marketplace. The commercial sector isn't doing nearly as well as the government thought that they would after they reopened, and now a potential second shutdown will cause some real negativity throughout the market. So again, inventory is the highest, brand new inventory is the highest that it's been this year. Now, that is something that we had mentioned in the past interviews with Simi Sara on the radio, on that this isn't a usual seasonal market. When you had no inventory in April and May, you'll see it come onto the market later. And now with some of the pundits and the real estate board saying it's a better market, you can actually see some of those sellers that say, man, I need to sell it. I was hoping 2020 would rebound, but maybe now is good enough. You can maybe start to see them come onto the market as well. And with that release of the demand, there might be some disappointment as they come to the market, and you'll see them continually chase the market lower. So there's that notion when you have your head in your sand and you're praying that it's going to be better, and you're reading some of the headlines and you're really optimistic that the market's going to do better. But then you put your property on the market and the market doesn't react the way you thought, that's instant panic. And I mean instant. So you're walking around, you're muttering to yourself, and now you really have to be proactive. And that wasn't your goal. So now once you know what kind of trouble you're in, it's a different mentality. And that's what we believe will continue to permeate going forward, is that the sellers really need to sell. There's no sellers that are really getting out winning the lottery. This is, I don't want to list the property, but we have to. So when the buyers continue to figure that out, as we're already seeing, prices do go lower as the inventory increases. So going into 2021, there will be increased need to sell. We don't really see too much increased need to buy. There won't be too much investing other than the properties that start to hit foreclosure. We're hearing all the time about how the mortgage in arrears are continuing to increase, and eventually they're going to have to pay the piper, or because they didn't pay the bank. So there will be foreclosures, there will be stressed sales that will occur to the market, and ultimately then you'll stop seeing these high-valued multi-million-dollar mansions sell when you can see maybe a dilapidated property in the area that might be going for $2 million. Why would I pay $6 million when I can build my own? And even in the lower lying areas where instead of $1 million purchase property, I can buy one for maybe a $650 lot value and make my own property. So as those permeations start to occur in the market, you really will start to see that average lower, because when you have lower average sale price or lower actual sale prices, that hurts the overall average sale price. When you have these high valued properties selling for even less than what they're expecting, but it still helps the overall average sale price. Going forward, we believe, again, there'll be more need-based sellers than need-based buyers, and very little to any investment as that mentality changes from, I'm buying an even market, to a fear of overpaying for a depreciating asset continues to increase. So I'll just toss this chart up here before we leave you again, this is the overall inventory for the Greater Vancouver detached market. We are still sub 5,000 active inventory. We're actually just over at 4,773 active listings. Now that is worse than December of 2018. During December of 2018, we had 5,000 active detached properties. We got no inventory. And it's not because, you're just holding off waiting for something better. You're holding off because you're praying for it to be something better. So when that doesn't actually occur, you're still going to be forced to sell. And is exactly why we had said in 2017, the sooner the better. In 2019, we did recognize or acknowledge that there were purchasing opportunities in many of the 20 markets, and that's why the individual reports are so valuable for our clients. During this period, there's very few markets that we would be investing in. There are markets that we'd be selling into these periods of strength over these last few months. And our realtors in the field and the managers that we work with, just speaking with one of the managers the other night, got together for a couple of beers. He says, just even over the last couple of months, I was getting from 4 to 6 calls a day to maybe 1 a day. So It's slowed down. It's changing. It is coming Eitel Insights way, just as we predicted. I mean, it is a slow-moving market. It's not the stock market. It doesn't finish off its technical moves within a month or 6 months. It does take a prolonged period of time, and that is, again, why in our original thesis, we did say 2017 was the market peak and 2021 would be the likely bottom. We don't flip-flop along the way. We don't try and churn you and say, you know, the market's down, you should buy now. Hey, how's that investment going? Well, it might be maybe not looking so good. It's time to sell. No, we sell you out at ideal times, and we're going to buy you back in at ideal times. So hopefully you enjoyed this podcast. If you did, again, please give us a thumbs up. If you're so inclined, give us a nice comment. We always appreciate those. And look forward to the condo market coming to you soon. Take care.